Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to the Dennis Money Show, where we help dentists make smart financial decisions. I am Matt, and I'm joined again with Tax Master Flex, Tom Whalen. I just made that up on the spot, Tom. How are you?
I'm doing well. How are you? Good to be back. Good to be back.
I literally just I was not even thinking. I was like, I'm just going to go with what comes from my heart, and Tax Master Flex came out.
I'm okay with it.
Does that feel okay? Okay.
Yep, that works. Coin it.
Well, we're excited to be joining forces again, as we mentioned for the tax series. So this is episode 3. As we mentioned, the very first episode, if you have not heard the first 2, we highly recommend going back and listening to those. We're trying something kind of new on the Dennis Money Show, where we're kind of going to start doing these series and grouping kind of bigger topics into these series more intentionally, rather than what oftentimes will happen, Tom, where Ryan and I will just start yapping and be like, oh, we should do a part 2. We're trying to get more intentional here. But this is episode 3 of the tax series. So we're trying to build upon these things. And today we're talking all things entity structure and tax allocation. If that sentence didn't make you fall asleep, I don't know what will. Tom, how excited are you for this topic?
I'm so excited. I will say one thing. I think that first episode in the series, it was like the kind of like background, like just the basics. So I do think that's a good one to listen to first. I don't know that these, 2, 3, 4, 5 need to be played in any certain order, but I do think that first one's a really good one to listen to first. So
yeah,
little plug for you there.
Yeah, thank you. I think it's a good point. We are trying to build upon them, but we're also trying to keep them somewhat standalone, where if you're just popping in and listening to one, you're still getting something out of it. But I do think the first one, we're trying to do our best to lay the foundation. So today, talking all things entity structuring and tax allocation. So where this kind of came from, Tom, as I was thinking about this and kind of laying out the outline, and as we were talking about this, I was thinking about a particular client who a couple of years ago did a startup and Scratch startup where they were about 12. I can't remember the exact time, but let's say it's about 12. It was somewhere between 12 months into the startup when they came to us. And so really early on, big investment into the practice, obviously, to get it started. So I think they had just started year 2 when they hired us. And one of the first things as we went through, among a ton of other things, but one of the first things we look at on the tax side is entity structure, and just kind of like what, and not that, us specifically. Now we have obviously tax and accounting with you guys, but even at the time, we still like to bring this up and collaborate with CPAs and all that. So looked at her tax allocation and her entity structuring, and I noticed, and she actually had brought this up. She's like, I'm a little confused by this. We elected S-Corp in year 2. And I was like, oh, that's interesting. Like, let's dig into that more.
Are you making loads of money already?
Yeah, exactly. So I was like, oh, you must be killing it. So anyway, long story short, we come to find out she was not necessarily killing it, which most startups don't in year 2. She actually had a very significant depreciation, massive depreciation. We're talking hundreds of thousands of dollars in losses or depreciation she could show. And she elected S-Corp. And we'll get into this of why this is a problem, but it was a problem. And here was the biggest thing here's kind of the biggest thing I wanted to bring up. I ended up getting on a call with her CPA because I was like, this is not right. Like, this is going to screw up a lot of things for you. I got on with the CPA and started to understand his rationale behind this. And it became very evident that he had no rationale. He was checking boxes and just kind of flipping through clients and like, oh yeah, like, let's do this. He literally said to me, exact quote, when I said, tell me the rationale behind this. Why did you elect S-Corp for her in year 2? And he said, because she'll have to do it at some point anyway. So we might as well do it now. And I was honestly floored. I was like, that is the antithesis of tax planning. I was just like, because she has to do it anyway? What are we talking about?
Yeah, that's tough. And then you hear it sometimes too, where it's like I'm a dentist and a lot of dentists are S-Corps, therefore I should be an S-Corp. And that might be true, might be true today, might be true 5 years from now. We don't know when that will be true, but that doesn't mean that we have to do it right now, or just because we're going to have to do it at some point doesn't mean it has to be right now.
Yeah. Yeah. I was honestly blown away by just the rationale
Or
alone.
lack thereof.
Or lack thereof, yeah, and it caused a lot of issues, and again, we're gonna break down kind of where these issues come up with this particular client when we talk about this or talk about entity structuring and tax allocation. So, I guess why this is so important, I think, and Tom, you and I, before we hopped on, agree on this, is that tax allocation and your entity structure is kind of an underrated part and can create a lot of underrated issues
For
for
sure.
practice owners if not doing this right.
It can save you a lot of money. It can cost you a lot of money. And more than costing you money, it can create a lot of just like kind of cash pinches where it's tough to access the money inside the business where without creating unnecessary tax burden. So yeah, I think it's very, very underrated. And I think people think about it a lot early on, but then they just kind of like, oh yeah, we had that discussion a few years ago. We don't need to do anything. It's like, no, this is something that we keep talking about as you go on in your practice.
Yeah, exactly. And I think what you said earlier is so perfect, is that a lot of dentists just assume, because of what's kind of out there now in the dentist sphere, of like, oh yeah, I just select S corp, like that's just what you do. And I think that's what leads to a lot of problems. So let's take a step back for a moment and talk about, as we again get more into the details of kind of the story that I told and how and the different things that this can impact, but or kind of what the things that entity structure determines, like what's attached to that, the ripple effects of getting your entity structure right.
Yeah, and I think I want to be clear that there's an entity structure set up for tax purposes, but also for legal purposes. So a lot of times people say, "Hey, I'm an LLC, and now I'm an S corp." It's like LLC is if I start a practice today and I set up an LLC, that is my legal structure.
Yes.
If I then elect S corp status, I am an LLC that is I'm legally an LLC that is taxed as an S corp. If I don't elect S status, I'm considered a sole proprietor for tax purposes. So LLC taxes a sole proprietor or LLC taxes an S corp, but no matter what, your legal status will always be LLC.
I'm so glad you brought this up, because this gets misconstrued and misunderstood for good reason. This is super complicated and confusing. I'm so glad you said that. So I think when we talk about this, people think S corp is an entity structure, and it's not. It's a tax allocation.
Further complicate things, there is an entity structure for legal purposes that's considered a service corp or SC.
Yeah.
That's not stand for S corp. You can be a service corp that's taxed as a C corp, or you can be a service corp taxed as an S corp. So a lot of times people think SC is S corp, and sometimes, but it's not, right? It's not from a legal perspective. So really
Glad the government made this so straightforward.
yeah, no kidding, right? So,
Crazy.
now there are some states that require medical practitioners, dentists, and all other sorts of medical providers to be a service corporation or a professional corp. Some states do not allow LLCs for medical practices, dentistry being within that umbrella. So in a state where you're not allowed to be an LLC, then you might have to be a service corp and you might have to go to S corp day one. I think this discussion today is going to assume that we have the flexibility to make the decision. Because if we don't, well, then it's just not really relevant anyway. But as long as you can choose one or the other, it's really, really important.
Yeah.
Yeah, understanding the differences, like what is a sole proprietor versus an S corp, and I can be an LLC as a partnership, or all these things. So there's a lot of terminology, a lot of different tax statuses out there, different legal statuses. So getting it all on one kind of baseline level is, I think, a good starting.
Yeah, totally. And I think with that said, Tom, I think if you take nothing else away from this discussion, I think it's what you just kind of highlighted, of this can be A, really complicated. B, it's really important to put a lot of thought and intention to this early on. So whether you're acquiring a practice or doing a startup, is to be thinking about this and having a CPA and having an accounting group that's going to be helping you determine what makes the most sense for you.
Yep, for sure. And I think, oh, sorry, go ahead.
No, I was just saying, thinking about the long-term implications, and not even long-term, short and midterm. Like, if we do this now, here's what it's going to look like in the next couple of years. Here's the impact this could have.
Bingo. And this really, I don't want to oversimplify too much, but it comes down to profitability. Like, what are we showing for taxable profits. And these are going to be a strong driver of the tax status we want to take. Think a really, really common path is that people will start their business, they'll create their LLC or their attorney will, and they will start off being taxed as a sole proprietor. And then you kind of, as profits ramp up and we get to a certain level of profits, depending on your marital status, then we eventually make that flip to S-Corp. But again, that might not be for 3, 4, 5 years. And doing it too early or too late, has its impacts.
Yeah, I've seen that. I see that too, and that's normally the path that we encourage people to consider with their accounting team or their tax team is that same exact thing. Can we? I guess let's just go there and talk about why is that the normal path? Again, we'll kind of like interweave all the different things that are impacted. What's the ripple effect on these different aspects of your business or life when it comes to electing S Corp status versus not? I guess let's just come back to the story that I told and break down why is it such a problem, or what problems were created by them electing S Corp so early in year 2 when she had no income.
Yeah. So a big difference from an S Corp versus a, say, sole proprietor is, especially in the startup world, because oftentimes there's going to be a loss shown in the startup world. There's a ton of depreciation, ton of interest, these big tax deductions that exist in year 1, year 2, et cetera. So we're not showing much, if any, taxable profits. Now, in the, we'll say, sole proprietor world, or sometimes the form that's filed through that is a Schedule C on your personal return. So if somebody says, hey, I'm a Schedule C or I'm a sole proprietor, I want to just say, hey, those are the same thing for this.
Yeah. Yeah.
In that sole proprietor Schedule C world, you can use loans. So generally speaking, people aren't funding their startups with cash. I think that's a fair assumption.
Yeah, pretty fair assumption.
Yeah, you can use those loans to take deductions against. Now, what I mean by that is if I start up a practice and I've got 800 grand into this, but I put, in terms of debt, I've got 800 grand of debt into this, but I have no dollars of my own. I put no money down. I can use those $800,000 of loan dollars as what's called basis. So now if I have a $1,000 loss in year 1, I can deduct that. Versus an S corporation, you cannot use loans, like bank loans, to fund your losses and deduct them. You have to roll those losses forward to a new year. So right off the bat, if we're showing losses and we can't deduct them, that like we are truly losing money, right? And we can't deduct it. It's like there could be some tax ramifications, but we might not have the cash to pay the tax.
Yeah.
Right? So that can create a pinch right there. Now, secondly, and what's a really big issue is in the S Corp world, the reason people choose S Corp, so I'm going to use a few different terms here. They're all going to be kind of interwoven, but there's 2 ways to pay yourself out of an S Corp. One is to pay yourself a wage, which gets reported on a W-2. The second way to pay yourself is what's called like an owner draw or a distribution, or there's a lot of terms, but distributions or draws are what we call those. But if you have losses, and again, we have no basis now because we have all this debt set up that, we can't use as basis. We can't take cash out. So the only way to pay yourself is through a W-2. And again, why is that good or bad or otherwise? Well, a W-2, we pay payroll taxes on it. Draws, we don't. So the reason we want to be an S Corp is to have a portion of our profits that are not subject to payroll tax. Well, we can't access that because we've got all this debt. Guess what? We can't deduct losses against our debt. So it creates this weird cash pinch that the only way to take money out is via a W-2 wage, which now we're just creating new payroll taxes that we maybe wouldn't have otherwise had to pay. So that's a lot there.
I think that's a great summary, though.
Yeah.
Let's break each pieces of those things down. So starting from the beginning of, I think again that was an amazing summary of why we see going one way or the other, and I think highlighting this timeline that you and I both see, which is early on, either with an acquisition, but definitely a startup, why you wouldn't elect S Corp for probably a couple years in.
Yeah, why not right away then, right? If I got to pay myself a W-2, whatever. So in the beginning, when our profit levels are probably pretty low, or at least low relative to where they will be a few years down the road, because we do have all this upfront depreciation and our interest is as big as it's ever going to be in our first couple of years. So our taxable profits might not be that high the first couple of years. Well, in the sole proprietor world, there's another tax topic here. It's called QBI, qualified business income deductions. A QBI which is the part of the Trump tax cuts his first time in office. What it allows you to do is 20% of your business income, you get to take a deduction for it. Now, there is a phase out range. Once we get to a certain level of income, that 20% goes away. But we're assuming at that point we're going to be an S-Corp anyway. But for now, we're going to assume that we're underneath that phase out threshold. So with the S-Corp world, we only get to take that 20% deduction on our draw portion. So if total profits are 250 and I'm paying myself a W-2, a wage of 150, and then I'll take 100 as a draw, my QBI is only calculated on that 100. But if I'm in the sole proprietor world, all 250 of that would be considered like draws, profits, whatever you want to call it. I get to deduct 20% of the entire 250, not just the 100 piece. So we can have more. In fact, all of our income in the Schedule C world is subject to this 20% QBI deduction. So that's a big benefit, huge benefit there. Whereas again, in the S-Corp world, the only piece that's you're allowed to take that 20% against is the piece that's not paid out as wages. And we know, maybe we don't know, maybe I'll just bring it up. We have to pay ourselves a wage in an S-Corp. That's like a really big hot topic button. Sometimes people would say, hey, well, why don't I just elect S status, not pay myself
a wage, yeah.
All 250 is draws, and then none of it's subject to payroll taxes. That is...
The IRS knows how that works.
There's numerous, if you just go Google reasonable comp, the term reasonable comp, and then S-Corp, you're going to get a million articles, and it's a really hot button or hot topic button. But yeah, so, and then I guess the drawback of being the Schedule C situation is that you pay payroll tax on every dollar of profit, 0 to infinite, right? Versus the S-Corp, you only pay payroll taxes on that wage portion. So my example earlier, I said, hey, we've got 250 of profits in either scenario. Well, in the Schedule C world, we're paying payroll taxes on all 250. Versus that S-Corp world, we're paying payroll taxes on the 150 that we paid out as wages. So
got it.
Again, now as the profits increase and increase and increase, and we phase out of that 20% QBI space, we're not getting that 20% benefit. So now all we're doing is just paying these excess payroll taxes in the sole proprietor world. That's when we're like, hey, no, switch to S-Corp, because yeah, you're not going to get anything for the 20% QBI either way. Well, at least let's get some payroll tax deduction here, right?
Yeah. So I love this. So the way you're highlighting that is this trade-off that you have to determine around balancing. I mean, there's a lot of balancing things about, there's a balancing act here a lot, but the one you just highlighted there is the QBI, depending on your income range versus payroll tax. There's a couple of things I want to hit on this, but let's go back to the beginning of this summary of kind of these trade-offs. Let me summarize, let me rephrase back to you and tell me if this is right. If this sounds, if a dentist could think of it like this. When it comes to the losses piece and the massive depreciation and interest and things that on paper show as losses, that's really what depreciation and amortization are. They're losses on a balance or on a P&L. So is it safe to say that early on in practice, whether it be acquisition or startup, when you've got massive losses, that when you're a sole proprietor, not taxing yourself as an S-Corp, you're a sole proprietor, most likely an LLC, the idea is that you can basically pass through those losses to your personal tax return and show no income, even if you actually have some income.
Yeah,
that
or like
goes away.
Say you're an associate. I start up a practice and I'm working 2.5 days a week as an associate somewhere else, and I'm working 2.5 days a week in my startup. I might have paper losses of, I don't know, 50 grand on my Schedule C on my startup practice, but I might be making 150 to 200 grand over here as my associate gig. Well, I can use that 50 of loss to offset my whatever of income over here. Versus in the S-Corp world, that loss gets what's called suspended. It just gets carried forward, and all it can do is offset future income that my S-Corp generates.
Got it. That's a great example.
Hung up, it gets suspended. Yep.
Yeah, it's a great example of love that you just brought up, like an associate, you have associate active income, and then you're doing a start, because that's really, really common in the startup world.
Super common, yeah.
And then coming back to the story that I told of my client years ago who had multiple 6 figures of depreciation and paper losses that she couldn't show, like, because she basically trapped them.
It's tough because now if I've got associate income from somewhere else, like I have these real losses in my practice, but they're trapped. And when I am not absolutely killing it, every dollar counts, right? If I can't use those tax deductions to offset my other active income, that might create this cash pinch that I wouldn't have otherwise had. If it's going to be a difference of 20, 30 grand in taxes, yeah, now we understand that we're not losing those deductions forever. They're just getting pushed out into the future. But as you know, if I can save 20, 30 grand now in taxes, that's going to matter so much more when my cash is as low as it's ever going to be than say 2 years down the road when I have tons of excess cash. I'd rather
Yep.
have that 20 grand today.
Yeah, totally. The other piece of this, just thinking of this particular client, that again, this was just a huge mess. Elected S-Corp way too early, took massive depreciation, by the way, via 179. So they took 179 deductions on
Yep.
all the equipment and everything. So just to I think piggyback a little bit off episode 2 that we did, why that's such a problem, and tell me if this is a mischaracterization, Tom, but the reason why I saw this as such an issue is she was showing no income anyway. She was showing no income anyway because she wasn't making any money. But then the CPA decided to elect S-Corp and then take massive 179. We're talking multiple six figures of 179 deduction, as opposed to putting that on a more elongated schedule to allow her to have future deductions or depreciation to offset the income that was naturally going to be growing in
Yeah.
years
And
3, 4, and 5.
bingo. And when you do that, like you said, you show zero income. It's like we're not really paying tax anyway. So why do we need to front load these deductions? Because now we're just pushing them into a lower tax bracket, which, like you said, gets into the prior episode too. Again, pushing deductions into a low tax environment is not great tax planning. It's just not. So we want to have those deductions go against a high bracket income instead of a low bracket income. So yeah, now we're crossing over episodes here. It's pretty neat.
Yeah, it's okay. Again, that's why we're trying to build upon these. But let's talk about. I do this with hesitation because it's a really, really complicated topic that a lot of people I think misunderstand. But I think it's important to try to tackle in this episode. You mentioned it earlier. Kind of the second piece of this summary of and the trade-offs that you're making is the topic of basis.
Mhm.
And the other piece, again, referring back to this client that this started to really is still creating issues for her, is what it does to your basis when you elect S-Corp too early and you take massive depreciation or massive deductions. Can we talk about that for a
Yeah,
moment?
yeah. So, like, what is basis, right? Like,
Yes,
maybe
yes.
back up a touch there. It's a floating target. So I get basis when I put money into the practice. If I put $50,000 of my own cash into the practice, I start with $50,000 of basis. Well, that's a moving target because I will take money out eventually. So if I put 50 in and I take 30 out, my basis is now 20. We also get basis when we have profits inside the S Corp that we leave inside the S Corp. So if there's $100,000 of profits that I don't draw out, my basis goes up by 100, right? So we've put 50 in, 100 of profits, now it's at 150. But then if I pull out, 30, now I'm at 120. So that basis is a moving target. Every single year we have profits or losses, but the losses that are generated, which are almost always generated from depreciation. The vast majority of dental practices are making money, like actually economically making money. But then, yeah, you buy a bunch of equipment or you do a startup practice or whatever, and you accelerate a lot of depreciation. You can show a taxable loss. But what that does, again, when there's losses and deductions, that reduces my basis dollar for dollar. Okay. So if I take all this 179 and I have zero basis, well, if that happens, I can't take money out of the practice. It locks up all this cash because if I do, I start to pay tax on it. And that's not ideal because then eventually I'm going to have to pay the loans back that I funded my practice with. And how do I get money to pay back the loans? Well, I generate profit. Well, I got to pay taxes on the profit. So it's like you're taking it out, paying a dollar, take out a dollar, I pay tax on a dollar, and then I pay that dollar back. I pay tax on that dollar as well. So when your basis is zero, that is not a good situation because now we can never touch any cash. And then a lot of times what happens is, again, if we take a bunch of 179, these are losses funded by loans, right? Well, eventually I'm going to build up a bunch of cash. So you can have a bunch of cash sitting in your practice with hardly any basis. People are like, well, why can't I take out, I've got 300 grand of cash. Can I take 100? It's like, well, no, your basis might be 0.
Yep.
It's because you took all that depreciation. So either if you take $1 out, if I give myself $1 of cash, that lowers my basis. If I take $1 of tax deduction via depreciation, that also lowers my basis. So what happens is sometimes people will take a bunch of cash out, and then towards the end of the year, the accountant's like, oh, shoot, there's all this income. We need to take all this 179. Now
Now
our
your
basis
basis is down to 0.
out, right? So it creates this pinch where I can't touch cash for a long time. That's probably what happened with your situation with your
Exactly what happened. And tell me if I'm wrong, Tom, but you said it earlier. Electing S-Corp too early is what causes this problem as well. That's the genesis of the problem, right? Because that's where it changes the status of how you take depreciation. It changes the status of your basis and how that's factored in, because that's exactly what happened with her. She elected S-Corp far too early, took massive, massive depreciation. Basis went to, it was 0.
0 or
And then
negative.
or negative, but then she's doing well in years 3, 4, and 5, has all this money that's piling up. And it's like, well, now it's really complicated to get that money out
Now
of the business.
how do I take this cash out? Well, what we always tell people, like you took it out in the form of deductions, but that a tax deduction doesn't put food on the table for me, right?
Yeah. It's just paper. Yeah.
Exactly. What you then have to do at that point eventually is you need to so you probably have this big pile of cash, but your debt's here. Like you need to pay down some debt, because people will say, like, well, what do I do with all this cash then? Like, I can't touch it. Like, what do I do with it? Pay down your debt. Like, that's the way to even out the basis. I try to use a simple example. If I buy $200,000 of equipment with $200,000 of debt, if I take 179 on that, now my assets, that equipment is worth 0 from a tax perspective,
On
but
paper,
my debt's still 200. So I'm upside down $200,000 in a basis scenario in that situation.
Yep.
Well, now if I've got 200 grand of cash, people would say, why can't I touch it? Well, because you're upside down on your basis. So what you need to do is first pay off that 200 of debt, right? Or to balance the scales a
Balance
little.
it out.
Now debt would be 0, equipment would be 0. Now any excess cash, I can build it up. Otherwise, you need to just keep a baseline level of 200 grand of cash.
Yeah.
Set that 200 of debt. And you can't touch anything up until our assets and our debts are balanced out.
Yeah.
And that can be really frustrating, because again, if I've got, on the personal side of things, I'm kind of scraping by, but I've got 200 grand sitting in the bank in my business account. Like, it just seems like I should be able to touch that.
Yeah.
Now, it's not like you're going to get in trouble if you do. It's just you are going to pay extra tax, and we are not necessarily in the environment of just manufacturing tax, which that's a good idea.
Or it can make things complicated, because tell me if I'm wrong here, Tom, but if you do end up taking that money out, you have to do a loan to shareholder, right, on the balance sheet. You have to actually track it that way.
So what happens is people say, hey, I'm going to take this money out, and then later on in the year, CPA is like, oh, shoot, we need to take all this 179. Well, you already took the money out, right? You already distributed it.
Yeah.
And you can't do both. See that, you take cash out, so you get $1 of cash or you get $1 of deduction. The problem is when you do both. That's when you create the basis issue. And when that happens, then the accountant will book a huge loan to shareholder. This wasn't a distribution. This was a loan.
Yep.
Well, the only way to either get rid of that is A, pay it back, or B, in future years, we chip away at it. We say, hey, we're going to write off a chunk of this loan and call it a distribution this year when we do have basis. And just you do that for 4 or 5 years or whatever the case may be to get rid of it. But again, it's really limiting your ability to take cash. Now, if we were in the sole proprietor world, you can do that, because again, you can use debt for basis. Whereas in the S-Corp world, the only thing you can use for basis is your own cash contributed.
Yeah.
Now with that being said, in the sole proprietor world, let's say we do that. We take 179 and we take the cash out. So we do have this negative basis, but that's okay in the LLC, the sole proprietor world. But if we want to make the switch to S-Corp, we have to get back to even. So you can kind of play that, I don't want to say shell game, but you're deferring your tax consequences. And oftentimes it's a good idea when cash matters the most up front. Now everybody's situation is different. We get that. We have to take that into consideration. But a lot of times we would rather have the cash today and deal with the taxes down the road. So again, if we're a negative equity situation, negative basis situation, which is okay in the Schedule C world, The only thing we need to note is that we do not make the switch to S-Corp until we're back at zero.
Yeah.
And if you switch too early, it's called phantom income. So for minus 50, for negative 50 in basis, what that means is you're just creating 50 grand of income when you make that flip. So then you pay tax on 50 grand of income that you don't actually have.
Yeah.
Now, I've been in a situation where we've done that because the payroll tax savings was so astronomical. They like just absolutely hit their stride and just crushed it. And we're like, this makes sense. Like, we don't want to wait another year to defer this S-Corp election because you're absolutely killing it. But we were very, very intentional with our plans there. It's like we knew exactly what the situation was. We could quantify the dollar amounts. And we made the S election maybe a year earlier than we thought, but that's just because they absolutely crushed it.
Yeah. I hope this is helpful. At least highlighting how important it is to have a plan around this and be intentional about this. But is it safe to say, Tom, obviously speaking to a general audience of dentists, so we can't know every single person's situation specifically, but I think it's safe to say that early on in your life as a practice owner, I'm going to say most likely in the first somewhere between 3 and 5 years, startup and or otherwise, it probably generally makes sense to hold off on S-Corp election rather than elect it too early.
Really, yeah.
Probably generally.
Yeah, exactly.
I'm
Now, again,
really hedging my bets there.
Conversations though, like it's not something that we want to just, hey, we'll shelf this for 5 years, right? It's like, let's look at profits.
Continue to think about it. Yeah.
What does the trajectory look like? And if you bought a practice, let's just say in January of 25, maybe you're not at the level yet, but maybe in Q4, you're tracking to make $500,000 if we were to annualize Q4. It's like, we might make that S election then, even though this year you might have big losses or very little income or whatever the case may be. But if we're tracking on an annualized basis, it's like, well, is this the new reality? Because if so, we're going to make that S election. But like you said, I would agree that it's very common that we're not making an S election for the first few years, just because, again, the depreciation and the interest is so heavy in those first couple.
Got it. So if I'm thinking about this the right way, I'm trying to like organize the kind of the way a dentist could think about this in kind of 3 phases of like early to mid career when it comes to thinking about what level you are on income. So level 1 would be basically showing zero profit, zero income because you've got such big depreciation, amortization, all that early on, that you're in phase 1 again. Probably generally, in most cases, in phase 1, you would not elect S-Corp. But phase 2 is an interesting conversation where you brought up earlier. In phase 2, it's where you're starting to get to that level of like playing the QBI trade-off.
Yes.
Is where are we with that QBI and how does that impact this? And then phase 3 would be like, I'm killing it. I'm so well beyond.
Yeah, I get no QBI benefit anyway, so let's get the skill tax benefit. Yep.
You've blown by QBI. So let's talk a little bit more, or just summarize a little bit more. So we've talked about phase 1. Again, you're showing no income. First year, 3 years, probably up to maybe even year 4 or 5, but for sure the first 2 or 3, phase 1, showing no income. It most likely will not make sense to elect S-Corp. You're going to cause a lot of problems. In phase 2, this QBI, can we just summarize one more time and just kind of like in this second phase of now you're in this kind of middle ground of where that trade-off they need to be considering?
Yeah. So again, the QBI, it's a 20% deduction on your profits. Okay. So if I have $100,000 of profits, I'm only paying tax on 80 of it. Super powerful, right?
Yeah. Huge.
Yeah. Super. And then in the S-Corp world, profits are defined as everything that's not wages paid to yourself. So if I made $250,000 all in, but 150 of that I paid myself as a wage, well, what's left over is 100 grand of profit. And therefore I'd take a 20% deduction on that, pay tax on the 80. In the Schedule C world, profits are all 250. So I'm taking 20% of the 250. My deduction is 50 grand instead of
$30,000 difference here.
Yeah. Yep. Exactly. Now, again, in the S-Corp world, I'm paying payroll taxes only on that 150 of wages I paid myself, versus in the Schedule C world, I'm paying payroll tax, I should say. Self-employment and payroll tax are kind of
up to the wage base.
up to the wage base, up to the 176 or whatever it is. But you do pay Medicare on everything.
I was going to say, then the Medicare is unlimited. Yep.
Social Security is capped every year. It's changing. This for 2025, it's like $176,100
And change. Yeah.
But then again, Medicare goes on forever. So at the end of the day, ultimately, that's what we're saving is Medicare, right? Because that will go away. I'm sorry, the Social Security will go away, but the Medicare, there's a few pieces of it. There's employer, employee, and then there's the extra Medicare surcharge. So when it's all said and done, it's about 3.8%. So we're saving about 3.8% on our profits eventually once we exceed that Social Security threshold. If there's nothing else to consider, there's 3.8% savings baked in once we're an S-Corp. Now, once we're past that QBI phase out, like you said, why wouldn't you take S-Corp? Because we're saving 3.8% across the board on our profits. But up until that point, it's like, does it make sense? Again, we got to look into that. There are other benefits potentially with state pass-through entity taxes where, we can get that to apply in the S-Corp world that wouldn't apply in the Schedule C world. So there could be more benefit beyond that. But again, generally speaking, that's kind of like when you're at the upper income levels anyway. So like you said, there's this middle ground almost where it's like, we're not there yet. We're tracking upward, but we're in this sweet spot where we're still getting QBI benefit and it's going to outweigh the payroll taxes that we're going to pay on the Schedule C.
Yeah, that middle phase is probably, it's actually kind of interesting because there's a lot of dentists in that phase, in that middle phase. Because
I want to highlight too, a lot of times we think, hey, once we're hitting around $400,000 of profit, now that's going to be married filing joint. It's really, I bet you it's closer to 450 of profits. It keeps ticking up. If we're married filing joint, 450 grand of profit, and I will back up, that would assume your spouse does not work. 450 of joint income, let's just say. So if my spouse makes 100 grand, then my profits in the business, once they're kind of in that 350 range, like we're having the discussion around S-Corp. But if my spouse doesn't work, kind of looking at that 450 range. But that again is taxable income. So let's just say I'm maxing out my 401k. My wife is on payroll. She maxed out her 401k. Maybe we have kids on payroll. I might have like a true economic benefit of $500,000. But my taxable amount, when I back off 2 401ks, when I back off some kids on payroll, I back off a standard deduction, now we're down around 400. You might say, hey, I'm making, my CPA says I'm making 500, but my tax return shows 400 or 390. What am I missing here? And it's like, well, not everything that you're making shows up on a tax return. So again, just because your P&L shows like true economic profit of 500 doesn't mean we're automatically switching to S-Corp at that time either.
Yeah, that's a really good distinction and good point, and highlighting the impact and ripple effect of, again, proper planning around taxes and the different, when you're in this middle phase of making between 300 and 500 or maybe even higher, it could be 550 of gross income, of total income, but the ripple effect of doing proper planning and having all these other deductions, all these other tools in the tool chest of, again, like you said, retirement plans, kids on payroll, Augusta rule, shared up strategically, giving to charity the right way from a tax perspective. Although like those things can have a multiplier effect if it gets you into the QBI range.
For sure.
As
Yeah,
well.
exactly. Because again, like if we're just above the phase out range, well, let's say now we're down into the phase out range and I put an extra, I don't know, I have a $20,000 deduction. Well, that's actually going to save me, like, you might think, well, it's, $20,000, but it's actually going to be like a $25,000 income reduction because if I'm now going back into the phase out range where I was out of the phase out range before and I didn't get the 20% savings, now I am getting the 20% savings. I'm going to tack that on there as well. So
yeah,
it's
big.
When we're in that phase out range or just out of it, coming back into it, not all dollars are created equally.
Yeah, that's a really good point. And when you can use things like a retirement account, 401k, HSA, things like that, where you actually can keep the money, but it can be removed from your tax return, like that's, or from your taxable income. That's a huge benefit.
And I think just to kind of put a button on that is like that middle section is we're making money. but we're still kind of playing with the benefit of QBI versus the costs of the payroll tax, because that's really what it comes down to
Yeah,
in
yeah.
that middle, in that second tier,
In
second
that
phase.
second tier. Yeah,
Yep,
that's really, really important. If you're out there thinking I'm somewhere in this range, which a lot of dentists are, this should be something you definitely want to be thinking about, talking to your CPA or accounting team, tax team about where, what these trade-offs are. Cause that's all this is making trade-offs. You're going to probably, depending on what you do, you're going to be paying more in payroll tax to your point, Tom, but it might be well worth it because you're going to be saving that much more on the QBI side. But you've got to be able to have someone on your side that's actually looking at that
for sure.
and being able to plan that out for you. Phase three, I think pretty straightforward. Once you blow past that and you're kind of like, you're at the level of you're making 500, 600, 700,000 beyond in profits. It's like
Yeah,
S
like
Corp
you're not
election is going
taking
to
the
make
QBI
sense.
benefit anyway. There's really no reason not. And no, never say never, but there's not a ton of benefit to not being an S corp. Now, if we're in a multi-owner situation, we might have a partnership, and let's say you and I own a practice together 50-50. The practice
We
we
would
own,
dominate, by the way. We'd kill it.
yeah,
We'd
exactly.
kill it.
I
Yeah.
do faint when I see blood, so I'm not sure that'd be
So we wouldn't do well. Yeah, me too. Get a little queasy.
right. But if we own this practice 50-50, this practice might be set up as a LLC taxed as a partnership, but then we might have our own little satellite S corp entities underneath that.
Really common.
Yeah, super common. Now, maybe I just bought in, right? Well, so mine would be potentially an LLC, now a sole proprietor. Yours might, maybe you're more established. You've been in it 10 years now. Now your profits are high enough that warrant switching to S Corp. Mine might not be there yet. But so we might have three different structures that the overall practice might be a partnership for tax purposes. Yours might be an S Corp and mine might be a Schedule C. So there's a lot going on there. But yeah, once we get to that point where we're above that QBI threshold, it's kind of, there's not a ton of reason to not be an S Corp.
Yeah. That's what that totally makes sense. Let's talk really quickly about another trade-off here that I think needs to be considered when you're out there considering S Corp election versus not, would be the actual cost of tax filing. I think that's something that doesn't always get talked about.
Yeah. Because I mean, when you're Schedule C, that's just a schedule within your personal tax return, right? And you don't pay yourself wages. So, like, maybe I'm like a 1099 contractor as an associate. I don't have any employees, and I get a 1099. There's not going to be a ton of cost of compliance, tax compliance, that is, because again, there's not a separate S corp return. Don't have to do payroll filings, W-2s, all that stuff. So there is an added layer of complexity to the S corp world. So that's a very, very good point. Now, it's not, like, generally speaking, I would think it's not going to be a huge dollar amount, but it might be a few grand over the course of a year difference if you've got to run the payroll now and do the S corp filings and whatnot. That wouldn't otherwise be there. So that's for sure part of it.
Got it. So something to consider, probably not if you're at this level of considering it, and oftentimes it's not going to be like, don't do it because it's going to add a few $1,000s to your.
Yeah. And a lot of times, I mean, I would say more often than not, it's like, if I own a practice and I have employees, I'm doing payroll anyway, right?
Yep.
So now if I flip to S corp and I add myself to payroll, there's really no added cost there because we were already paying for it. The added cost in that world would be like just the S corp filing.
Yep.
But again, if we are a 1099 contractor, now I have to have a P&L and a balance sheet. Like, you know what I mean? I don't just take my 1099. There's more to it. So yeah, there's for sure going to be some added costs there.
Got it. Tom, this is maybe a whole other podcast, but I still need to bring it up while we're talking entities and tax allocation. Occasionally we hear, very rarely, but occasionally we hear a dentist who says, we're going to create a C Corp. We're going to go C Corp. This used to be more common back in the day, but now we rarely see it. But I guess I'll just ask it this way. Is there a situation that a C Corp would even make sense for a dentist?
So again, never say never, but usually they are older. And it would be, I don't say cost prohibitive, but it would be, I have a C Corp client of mine, and they fit the absolute mold of why would somebody stay a C Corp, right? They've got 5 owners. And in the S Corp world, we haven't talked about this, so I'm glad you brought it up. We have to pay out these distributions or these draws. They have to be paid out in the same proportion as our ownership percentages. So again, if you and I own this 50-50 practice, that's an S Corp. distributions have to be paid out 50-50. Well, what if based on our comp formula, I'm only supposed to make 200 grand this year and you're supposed to make 700 grand? Well, my maximum distribution I could take would only be 200. But we know that I have to pay myself a W-2, a reasonable W-2. Uh, and maybe a reasonable W-2 might be $200,000. And therefore, I would have no room for distributions. And therefore, you would have no room for distributions because they have to be paid the same amount, right? 50-50 in this case. But so I have a practice that's 5 owners, and the way their comp formula works, one of their owners, and they're all 20% owners, one of the 20% owners just doesn't make a ton relative to these other 4 owners. And therefore, there's just really no room for distributions. And they've always been a C-Corp from way back in the day. We haven't made the switch to S-Corp because I'm like, I can't pay distributions to you guys because, again, the lower tier earner isn't making enough that would justify us paying any out.
Got it.
Now, and again, I wouldn't set them up day one as an S-Corp. I'm sorry, I wouldn't set them up day one as a C-Corp.
C-Corp.
Because they've been an S-Corp, I'm like, well, there's no reason to switch at this point because we're not going to get any benefit anyway. And then we don't have to go through the exercise of actually doing it. If and when, now I think it'll be a few years, but when this lowest earning provider is out, we'll probably flip to S-Corp at that time because, I mean, she's getting older and that's the reason why she's not making as much because she's just not working as much. So when the rest of them are making some and they have enough room in their comp formulas to justify paying out distributions, then we're going to make that switch. But again, like I wouldn't start them up from day one. There are some like health insurance benefit plan type things that are, beneficial potentially in a C Corp versus an S Corp world, but usually it doesn't outweigh the added or the benefit of the payroll tax savings.
And it might get
kind of the same thing as you got to pay everything out as wage because in the C Corp world, whatever you leave in there as profits and don't pay out as wages, then you got to pay C Corp tax and then you pay it out to yourself and then you got to pay dividend tax. So it's 2 layers of taxation.
Yeah.
I mean, I don't have any particular clients. In fact, I don't know that we in our current client base across the company have people who we've opted to make the C Corp.
C Corp. Yeah. That's what we've seen over the years too. It's really, really rare. And what you said is where we do see it is old school. Like, I mean, a dentist who did it from years and years and years before.
Yeah, and S Corps are not super old. Like they haven't been around since the dawn of time. C Corps were.
Yep.
Like everybody, old school, like you said, they all started out as C Corps because they all needed to be, professional corps or service corps. Well, C Corp was the only potential option. And then LLCs came about, I don't know, 30 years ago maybe, and S Corp's right around similar time. So like this S Corp thing it's still kind of old, I guess, but not like in the whole tax code, S Corps are not old. So making that election, you get a lot of these docs that are in their 60s and they just haven't switched over yet. And then there's maybe it's a different discussion for a different day, but the whole built-in gains from switching from C to S, you got to have like a 5-year cool down period. And if I've got less than 5 years to practice anyway, well, then why would I switch? Because I've still got this built-in gains issue that'll be with me till I sell. So that's something that we always deal with too is if, hey, when are you going to retire, doc? I don't know, in 2 years. All right, well, you're still within that 5-year window. We're not going to make that switch.
Yeah. I'm glad you brought that up too. And the story you told even is there's a big difference in saying we would have elected this before. Like if you were starting today, we'd elect this for you versus we're going to keep you in it. Those are 2 different things. There's a lot of reasons to say we're just going to keep this where it is. Same thing with the client I mentioned to start this whole thing is there might be reasons like it might have been a massive mistake to do that, but it doesn't mean we're going to reverse course now and like completely deconstruct it and change it.
You can if there's kind of a finite situation or fact pattern where it would make sense. But if you elect S status, you can revoke that election, but then you can't re-elect S status for another 5 years. So it's like, if we're again, we
find that
balance. We're at year 2 and we figured by year 5, we're kind of make that switch anyway. Well, we're not going to elect that in say year 3 because we're so close enough to year 5. Like so there has to be a pretty narrow fact pattern for that to make sense.
Yeah.
But it can technically be done.
But again, considering the difference in saying I wouldn't have done this the first time, but here we are now. Let's think about like what to do from here. Like it's not helpful to be like, I would have never done that. It's saying, okay, here's where we're at. Here are the trade-offs we're going to make now, or the things to consider if we're going to like, revoke that election. Here's what that means. It's a whole other discussion versus people that are listening to this. Hopefully you're in a situation where you have the choice, or you're considering the choice beforehand versus like, oh, I'm in this mess now. What do I do?
Yeah. Like life changes too, right? I mean, you might buy a practice and you're like, I'm going to light the world on fire and I'm going to go take it from 800 grand of collections to 2 million. And I'm just going to, blow the roof off, all those superlatives. I don't know. Maybe you have, instead of having 1 or 2 kids, you end up having 5 and you're like, boy, I just want to be at home more. I've got so much going on in the home life. Like I can make 300 grand comfortably. And that supports us. And I don't really need to go crazy with it. And maybe we were waiting to elect S status, or we did elect S status because you were on that track. But now you're like, I want to reverse course because
you're backing off.
It's changed so much. We can do that. Now, again, you can't re-elect S for a while, but like life changes. So again, it's one of those, we talked about it earlier. It's not one of those things that you just set it and forget it. It is something to just continually monitor. What's your life situation looking like? What's the practice situation looking like? Does this still make sense for today and for the next however many years?
Yeah. So good. Tom, to wrap this up, I want to probably let's summarize the common mistakes that we've kind of like been alluding to throughout this entire discussion. And then we can summarize the solutions with things to be thinking about from here. So the common mistakes that I'm hearing as we go through this is, number one, no particular order, but so staying a sole proprietor too long. There's some mistakes there that could be created if you stay a sole proprietor LLC and not elect S-Corp. If you wait too long to do that, I think what I'm hearing is that what we see is paying too much in payroll tax.
Bingo. Yep.
Okay. Number 2 would be electing S-Corp too early. And we highlighted that being basis issues, locking up losses within the practice you can't fully utilize, creating some issues with like paying yourself a wage. How do you do that? I think the other thing we didn't highlight, even though it's still low, the S-Corp election can increase your chances of scrutiny from the IRS.
Yeah, I would say I would agree with that if you're not paying yourself a reasonable wage. But that simply doesn't exist if you're a Schedule C, right? So if you're like, hey, I'm going to elect S and I'm going to pay myself a reasonable wage, no added scrutiny. But if you're not paying yourself a reasonable wage, absolutely there's added scrutiny.
Got it. That was the next thing on my list, was electing S-Corp but not paying yourself enough. So paying yourself artificially too low of a wage or not a wage at all, that's going to be a problem.
Bingo. Yep. And there are people that do that. And I just think you're really sticking your neck out there. Because a lot of times people are like, hey, maybe I was an associate at this practice and I was making $250 as an associate. But now that I bought the place, I'm going to pay myself $150 or $120. And it's like, well, I would argue you should pay yourself more because you're doing more. You're putting more out there, putting your neck on the line to be an owner. The IRS would argue that. Now, obviously, we play the game a little bit and try to understand where a sweet spot is. But I just think a lot of people have flawed logic. And if I was making more as an associate, now I'm making less as an owner. It's kind of like that. Maybe a little bit of a red flag.
Tough to justify that for sure. Okay, and then paying yourself, so electing S-Corp but paying yourself too much in W-2 wages, possibly overpaying in payroll tax. There's a balancing act here as well that we didn't even get into around, making things more simple with quarterly taxes versus just paying everything through W-2. But I think this is something to be considering, of paying yourself too much can sometimes get you paying unnecessary payroll taxes.
Yeah, I mean, that's why we switch, right? Like that's why we switched to be an S-Corp, is to save on payroll taxes. So again, if you were making 300 as the associate, I know I just said a minute ago, we don't want to just cut it down to nothing, but we do want to take an appropriate measured response and kind of get our way to where we want to be. What's reasonable? Everybody's different. Obviously, every practice is different, but yeah, that's why we switched to S-Corp, is to save the payroll taxes on the wages. Yeah, we see it a lot of times where they're just overpaying, and it's like, well, we don't want to cut it down in half overnight. Maybe it might be a multi-year approach to not really you don't want to pay yourself 400 and then 150. It might be 400 and then 380 and then 330 and get our way down there eventually.
Yeah. Great point. And then the last one, kind of been a theme through this whole discussion of treating this as a one-time decision and a one-time act, where it's not something you're reviewing on a regular basis. I think that's a really common mistake that we see.
And again, you might get to a point where you are done with it, right? If we're 10 years in and I'm making $800,000 a year and you're good forever, you're going to keep doing that forever. Honestly, you're probably done with that piece of it. But if our income's like this, or just tracking upward or tracking downward, I mean, there's a lot of times, a lot of situations where you just need to have the discussion. It might be a 15-minute discussion every year, but at least have the discussion.
At least be considering it. Yeah. Okay. So kind of the flip side of that, I think there's just, we've alluded to this, but I think choosing the right entity and tax election for your stage of your practice, depending on where you are, generally speaking, if you're early on, it's probably not going to make sense to do an S-Corp too soon, but be thinking about that and be talking to the right team and having the experts in your corner, setting your W-2 income if you do elect, or when you do elect S-Corp, intentionally. And like you said, finding that balance, reviewing this on a regular basis. And then the last, I think most important one is have a team, coordinate with advisors and a team.
Yep. I was going to say that too. Like, get your attorney should be involved in this discussion as well, because again, I said it earlier, but there are some states that do not allow for LLCs. Now, some of them allow for PLLCs, which is a professional LLC, but some states don't even allow those. So we might not even have this option. So if you're going into, buying a practice and we're doing our due diligence and we're just assuming that we're going to be a sole proprietor and we're kind of basing our cash flow off that, and you're in a state that doesn't allow for LLCs, like that's be good to know on the front end. So again, not just your CPA, but get your attorney, your advisor, get everybody.
Yeah, so great. Well, Tom, we did it. We were able to officially do a podcast on entity structure and tax allocation. Hopefully it's helpful for everyone. Any final words of wisdom on any of this?
I don't think so. I just get everybody involved, get your team involved. You have a team, use them. I couldn't stress that enough.
Yeah. And don't assume. I think that's a key theme here too, is don't assume the whole classic because everyone's doing it, I should do it. Yeah, eventually you'll be an S-Corp most likely, or you will elect S-Corp as an LLC, but it doesn't mean you should be, timing does matter here.
Timing absolutely matters.
Big time.
For sure.
This is awesome. If you're still listening, you're one of the cool ones. We really appreciate it, especially on a tax episode. If you want more, Tom and his team and us have teamed up, and I'm going to really give Tom all the credit here for, I believe, our second or third annual year-end tax checklist. So really, really helpful.
Thank
you. What?
It's coming out soon. I just finished that up.
It's available. It's ready to go. So you can actually check it out. DennisAdvisors.com/2025. You can get the updated version that we had last year of 2024. You can get the updated version now on the website. It's DennisAdvisors.com/2025. It's our year-end tax planning checklist. Highly recommend checking that out. Take it to your CPA. If you need a CPA or tax team, guess what? Give us a call. We actually do that. So check out DennisAdvisors.com. You can book a free consultation there by clicking the button. We'd love to talk to you. If this was helpful, if this episode was helpful to you and you think there's dentists out there that need to hear it, we'd love for you to share the episode. We want to be able to share the good word and hopefully add value to the dental community. We'd love for you to share the episode. But for now, Tom, thanks so much for being here and sharing your wisdom. Everyone, thank you so much for listening. Until next time, take care. Bye-bye.